Let's go to Edinburgh, Scotland, and get started here. Andrew Milligan joining us from Standard Life. Good morning, sir.
Hello, good to see you.
Good to see you from your office there. Nice Bloomberg in the background. Andrew, when we look at Greece now, is this any different than the story we've heard in recent months and in recent quarters, or is there something new about the soap opera now?
I don't think there's really anything new. We've known for some time that ultimately Greece does need to restructure its debt. The question is how, where and when. I think to a certain extent, because of the most recent finance ministers meeting, the run-up to some more important meetings in June, and people beginning to look ahead to the fact that come spring of next year, Greece would, all being equal, return to the markets, and that looks to be difficult. Yes, they're going to need either some more finance or some form of restructuring. I think that debate has been around for some time. We're perhaps a little further advanced in people beginning to bite the bullet, but I don't think this is a new story.
And Andrew, let's bring up dreaded first chart here. This is the recent and the sudden surge. I mean, I'm sorry, it's been springboard up. Have the markets just lost complete faith in the European process, or are the markets losing faith in the Greece leadership's ability to get out of this?
I think because we are 1 month further on from the towards the realisation that there is likely to be some restructuring of Greek debt. Of course, certain people at the margin are being forced to make investment decisions, and prices have changed accordingly. But in the great scheme of things, we've known ever since Greece went down this process that ultimately there would have to be some rescheduling of Greek debt. I've seen one paper suggesting 6 different ways in which the debt could be refinanced. And we're still a long way away of knowing which of those 6 would be chosen and what the implications would be for financial companies in Greece, outside Greece, and for governments. So I think that the realisation has grown in certain sectors of the market that an event will happen in the future. I still don't think it's going to be happening this year, quite conceivably not even next.
Andrew, let me bring up this chart, which surprised me, folks. I'm supposed to know what I'm talking about. Here's German GDP, and you can see that I'm going to call it a boom. Maybe it's not a boom, but it feels like a relative boom. A German boom at peripheral expense, that's 4%. Real GDP in Germany. If that's coming at the expense of the peripheral, with all the Euro machinations out there, you're still investing in Europe. I think that's a key message today. Are you still optimistic on core European equities?
Absolutely, because core European equities are not really based upon what's happening in the peripheral European economies. I've seen one suggestion, for example, that Portugal, Greece and Ireland together are about the GDP of Florida. You know, and Europe as a whole is about the same GDP as America as a whole. So that German GDP figure is very obviously based upon its extreme success in exporting, particularly to the emerging market economies of Asia and Latin America, plus also the benefit of being so close to Russia, which is another powerhouse desperate for the sorts of machine tools that Germany can produce. And the benefits of that are feeding through into the UK, France, Italy as well. So yes, Germany is doing very well, and indeed on some assumptions it's probably getting close to full employment in Germany, or not that far off if it continues to see. It is remarkable, but then one must remember the competitiveness of the German economy has improved dramatically, not just against the periphery, but against most other countries like America, for example, in the course of the last few years. They took very stern steps before and during the crisis to make sure they came out competitive. All that's happened with the periphery is that it's helped push the euro lower and made Germany even more competitive compared with the rest of the world. And for the good benefit of the whole of Europe, that's happening, actually. Right. So yes, European equities, selectively go and buy them.
Andrew, in our last question to you, you've published very positively on profit growth. Are the banks part of that? That's been the big debate, not only at Surveillance Midday, but Bloomberg Surveillance, whether the financial companies, given a lower nominal GDP and a tougher operating environment, do you want to be equal weight or overweight the financials here?
I think one would have to be equal weight on balance in financials, not just in the US, but in most countries at the moment. I mean, you're quite right. We are not looking for a rapid economic expansion in any of the OECD countries. Loan officer surveys suggest that bank lending is slow, and the regulatory environment will only get tougher, I think, in most countries going forwards. No, our views on profits are very much based on industrial sector profits, business-to-business profits, such as advertising, the profitability of selling high-valued goods, your Burberrys, your expensive handbags to the emerging middle class in Asia. That's
right.
the sort of areas that we can see the profits. But classic retail, very difficult. Classic financial, on balance, difficult. There will be some winners, but some losers
Right.
too.
Thank you, Andrew Milligan, Standard Life in Edinburgh, Scotland.